what we will be talking about is a fairly grim topic, but it is a topic which touches all our lives and will continue to touch our lives for, for a while. I mean, the belief that we are going to come out of this very quickly, I think, is completely misplaced. And that's what I'll be elaborating on. So let me begin by making something very clear. I mean, what we normally do nowadays is to attribute almost anything that happens in the country to COVID. But when you're really looking at the economy, it is only tangentially related to COVID. It is principally related to the fact that governments in different parts of the world have reacted differently in terms of managing the disease. And in this respect, India has now become a global gold standard in the sense that, the severity and the extent of lockdown in India has been far, far greater than in almost any other country in the world, except for a few smaller countries. But what really is quite surprising is that if you look at the the kind of estimates that are being made, particularly by the rating agencies and by investment bankers, India looks pretty good in terms of its economic performance. Other countries which have done lockdowns of much lesser severity are projected to have far worse economic outcomes. And this has been a puzzle to me, which is why I set about trying to write this particular paper. But more important than that, uh, I think there is a global belief, and I think it's a belief a lot of us share, that India is, for some reason, more resilient as an economy than other economies are. And really, the question that we need to ask is, where does this belief come from? Well, one of the reasons is that if you look at the other two really big shocks that we have experienced in the recent past, the first was the global financial crisis, and the second was the demonetization come GST episode in 2017. India actually came out of both of these shocks very, very quickly. And I think that has given everybody a sense of confidence. But the question, of course, then is that is there anything significantly different about this particular shock as compared to the two previous ones, where we may not be able to come out of it with the alacrity that we did earlier? And the answer is yes, this shock is different, and it is significantly different. The first, and I think most important point, is that if you go back to the global financial crisis, India was actually not very badly affected. The rest of the world got badly affected. We were not. We were affected indirectly through the impact that the global shock had on our exports. And when you actually work those numbers out, the numbers are not large. So the shock was a large one for the global economy, but it was actually a fairly small shock for the Indian economy. And naturally, we came out of it quickly. But there's a second learning, which is that that was the time when, both fortuitously and by design, the government actually reacted very quickly. And within the same year, remember this happened in 2009, in 2009-10, the government actually increased its fiscal deficit by 3% of GDP, which was roughly the kind of damage that we had experienced from the export side. So the extent of the fiscal corrective was almost as large as the shock that we had faced. Now, the net result, of course, was that since the government policies took time to play out, We suffered in 2009, but we came out of it very, very smartly in 2010. In the case of demonetization, there is a difference. Demonetization was a fairly major shock. But there were two features which I think we need to take into account, and I'm mentioning all of these because it will be pertinent to what I talk about as we go forward, is that there was a statistical illusion that happened. Demonetization hit the non-corporate or the unorganized sector in India disproportionately, and it actually made life better for corporate India because since the non-corporate sector was not being able to transact business for the lack of cash, corporate India stepped into a part of that space and actually gained market share at the expense of the non-corporates. Now, since our national income accounts, our GDP data, dominantly captures the effect of corporate India and captures the effect of non-corporate India with a long time lag, we had a very peculiar situation where we had a large negative shock, but our growth actually increased. Well, our growth as a country didn't really increase. What increased was the growth of corporate India. But the fact of the matter is that at the end of the day, the rest of the economy catches up with you. And post 1718, when we saw 8% growth, growth has been slipping for 9 quarters in a row. So from a high of a little over 8%, we are now down to 3.1% over a period of 2 years. So the dog may bite late, but it bites, and it has bitten us. This particular shock is different. First of all, while it is a global shock, in this particular case, India has been more adversely affected than most other countries. And this was the point I was making about the extent of the lockdown. The second is that this is a shock which has affected not only non-corporate India, it has affected corporate India just as badly. It hasn't affected the employees of corporate India who continue to get their paychecks, but the companies in which they work, they are bleeding. So this is the background. So the statistical illusion that we saw in 1718 is unlikely to play itself out this year. So expect bad news when the data actually comes out. Now, so let me get down to the bad news. Now, the extent of the bad news is still a matter of debate and discussion. Practically every economist in India has taken it up as his own little private cottage industry. And the estimates that people are making vary fairly substantial. So what we do have is you have, let's say, the State Bank of India, who is saying that the first quarter of the current year, where the bulk of the shock exists, will show a minus 40% growth. Minus 40%. There are others who are talking about it somewhere around 16, minus 16%. I fall somewhere in the middle, and my take is that, and this is a little specific, which is that the shock has been roughly 2 trillion or 2 lakh crore rupees per week of lockdown. And so since the lockdown has been sort of sequentially extended and may come back, one will have to work out what the real effect is as things develop. But as things stand at the moment, we have experienced about 18 lakh crores or 18 trillion rupees worth of production and income loss in the country as of now. Now, this is the first shock. This is income loss. But this income loss doesn't reverse itself immediately. What happens is that in economics, there is a concept called the multiplier, which means that when there is income loss from any shock, it plays itself out over the next year and a half. And it plays itself out gradually, it diminishes to zero. The effect diminishes to zero. But cumulatively, over the next 1.5 years, the size of the secondary and the subsequent rounds of the multiplier will add up to about 2. Now, given this, what we are really looking at is a shock of roughly 18 trillion rupees, which over the course of this year, and I'm talking about this financial year for which data will be reported, comes out to be about 27, 28 trillion. This is the result of the lockdown itself. Now, 27, 28 trillion, if you break it down, you're talking about almost 14% of our last year's GDP, which is a huge amount. But the bad news doesn't stop there. As I had said, that we are certainly affected, we are affected worse than others, but the fact is other countries are locked down as well. The global economy is in trouble. The IMF and the World Bank have now reduced global growth to an estimate of minus 3.5% during the course of the current year. So there's going to be another game being played out there because our exports are going to go down, which means added to the impact of the lockdown, even post lockdown, you're going to have exports still continue to go down. Not because production cannot happen, but because the global demand will not be there. So when I play this out, it adds to the damage. Now, against this, the government has taken a series of steps. The earliest step was taken on March 25th by the finance minister when she announced the PM Garib Kalyan Yojana, which was on paper 1.7 trillion rupees or 1.7 lakh crores. But when you actually looked at it a little more carefully, what you found was that it was actually a repackaging of a number of expenditure items which are already included in the budget which had been placed in February. So these were not additionalities in any sense. The additionality was only about half of that. It was about 0.8 trillion or 0.8 lakh crores. The second step that was taken was by the Reserve Bank of India, and all credit to the Reserve Bank. They acted quickly, they acted decisively. And what they did was essentially put a moratorium on the repayment of loans taken by everybody from the banks and the NBFCs for a period of 3 months, which means repayment didn't have to be made, so that if repayment didn't happen, the banks couldn't declare them to be non-performing assets. Now, this was an important step. The RBI also did something which was required, which is they recognized that this would put a lot of strain on the banking sector. And to address that, they pumped in a large amount of liquidity into the economy, into the banking system in particular. Now, these were good steps, except for one dimension, which is that moratorium that was given on loan repayment was not made mandatory. It was left to the discretion of the banks. Now, the reason why I say that this was an error is that the banks had already been suffering, and we all know that the banking sector and also the NBFC sector were in dire straits before COVID struck, and we've been talking about it. All of them have become extremely risk averse, and they are unwilling to stick their neck out and give what is effectively a fresh loan to anybody they are not confident of. The net result is that depending upon which bank you take, the extent to which they have extended moratorium has varied from a high of 70% to a low of 23%, which means that a very, very large proportion of our production sector has not been granted moratorium. Now think of what that means. You have had a 3-month period in which these companies have made absolutely zero income, but yet they are expected to service their EMIs and their repayment to their creditors. It's very difficult unless you have very, very deep pockets. Now, what that will do is that the smaller entities, which tend to have fairly small amounts of reserve, are going to suffer disproportionately hard. That is, a lot of them may close down and probably have closed down by now. Corporate India, not so bad. Corporate India does have much larger reserves, but even they will suffer because a lot of their reserves are in financial assets, and unloading financial assets at a reasonable price is not that easy. We all know that the BSE and the NSE have plunged, although now they've stabilized and have shown a small uptick. But from the point at which these investments were made by the corporates, it's gone down by 30%. So even the corporates will have a hard time, but I suspect they have enough reserves to be able to tide over the period, provided it doesn't get extended further out. The third tranche of the government's action came with the announcement made by the Prime Minister about a 20 trillion rupee or 20 lakh crore rupee package, which was called Atmanirbhar Bharat. And the finance minister laid out the contours of that package for 5 days following the PM's announcement. And when you actually sifted through all of that, what you found is everything had been rolled into that package. The Garib Kalyan Yojana was a part of that package. Everything that the RBI had done was a part of the package. There are only two elements to that package which were new. The first element was that the government guaranteed the loans to MSMEs, not to corporates, but to MSMEs. Number one, which was a good step in my opinion, but nevertheless, it should have come earlier, but we leave that aside for the moment. The second step was an added fiscal stimulus by way of extension of the Garib Kalyan Yojana uh, for a longer duration. Now, when you added up the fiscal stimulus component only, it came to, unfortunately, a rather measly 1.3 trillion um, or 1.3 lakh crores. So when you put it all together, the stimulus that the government, which is the positive shock that the government has given, is about 2.1 trillion rupees. So that's where we stand. Now, when I did my exercise, I started with the assumption that the moratorium that the RBI had extended and was then backed up by the government with partial guarantees would be extended to all borrowers. So that's a core assumption, and it's a very strong assumption if you think about it. If you do that, and if you also assume that the lockdown was lifted as of 1st of June, which hasn't quite happened, it's a partial lifting has happened, not entirely. If I take these two together, Then the effect on GDP in the current year, taking into account two negative shocks, one from the lockdown, one from exports, and one positive shock, which is from the fiscal stimulus of the government, I come to a net position of a minus 12.5% growth for the current year. But, and this is where the but comes in, this particular minus 12%, actually, when you distribute it by quarters, and therefore you start looking at quarterly growth rates, which is what the pink papers talk about all the time, it shows a very specific path. It shows a very large drop in the first quarter of minus 32%. It then becomes smaller negative shocks of minus 8 and minus 5% in the next two quarters. Then in the fourth quarter of this year, it actually goes into positive territory. You see positive growth in the fourth quarter. And the first quarter of next fiscal, you actually see very strong positive. Now, given that you will be seeing a continuous upward movement in the growth rates of the GDP, may lull you into a sense of complacency, saying that India has done it again. We are back to being the most resilient economy in the world. The bad news is that from the second quarter of next year, expect growth to go back into negative territory and stay there for the next couple of quarters. And if nothing further is done, next year as well, we should be looking at a negative GDP growth of somewhere around minus 8%. Things start improving only towards the end of the year. And then the economy starts climbing back fairly steadily. But given the magnitude, so you're talking about minus 12.5% in the first year, minus 8% in the second year, so we're talking about a total of about 22% down. When you recover, the recovery is not going to be fast enough for us to get back to the 2019-20 GDP for the next 3 years. So we are looking at a situation where we regain last year's GDP 5 years down the road. Now this, to my mind, is really a scary scenario. Because remember what I said, at the heart of all of this is the assumption that production capacities have not been damaged. But if you have a 5-year period where production is below what it had already achieved, the damage to production capacities will be large. It will not be confined to MSMEs. No corporate has that kind of deep pocket. Then things can get worse. But I have not taken those into consideration up to now, because that then would become a really frightening story, and we would be looking essentially what happened during the Great Depression. Okay, what should the government do about it? Well, the answer, I think, is fairly straightforward. And this is the learnings that I've been talking about from the past. The answer is that the government has to step up with a significant fiscal stimulus, and it has to step up with it now. The longer it waits, the larger will be the damage to production capacities. The problem, of course, lies in the government's ability to ramp up its expenditures sizably. So if you think about it, one can break up the stimulus into two components. One is what the government is already doing, which is direct income transfers. And the second is what one normally means when we talk about a fiscal stimulus, which is investment in infrastructure and other public purchases of goods and services. Direct income transfers are great. They have a lot of positive features. First of all, they address, provided you can identify the beneficiaries properly, is that they take care of the humanitarian crisis that we are going through and we will continue to go through for a while. The second is you can actually pump in a lot of money in a fairly short period of time. At the moment, the DPT, the direct income transfers, are relatively small. They are 500, 1,000 rupees every month for the next 6 months, and 5 kilos of grain and 1 kilo of dal per person for the next. This can be ramped up very easily. In the first instance, the 500 or 1,000 rupees is really quite a joke. The minimum that we should be talking about is 3 to 4,000 rupees. I would prefer it to be larger. The advantage that this has is that, as I said, it can be done very quickly. There is really very little to hold the government up because it essentially means simply issuing an order to the banks to just put the money out there and the government reimburses the banks. But the downside of direct income transfers is that they tend to have low multiplier effects. So if you're going to rely excessively on direct income transfers, the size of your fiscal stimulus will have to be larger than the size of the negative shock itself. As far as the second element, which is public investment in infrastructure, is concerned, the multiplier is large, very strong, but it has two drawbacks. The first drawback is that it takes the government a long time to get approvals for these kinds of expenditures. And since time is of the essence, the work on that has to begin now. And this is not in terms of the great infrastructure pipeline that we have, which are major projects. What we are talking about are public infrastructure projects which are small, which do not require long lead times, which are labor intensive, so it has very high component of wages. Those are the kinds of things that they should be looking at. But even if they do, the fact of the matter is there will be a limitation because the government cannot and will not bypass procedures and processes. So there's a limit on how much the government can spend during the current year. And my best guess, estimate, having looked at the ability of government to spend over many years in the Planning Commission, is that I don't think that in the current year they will be able to set in motion, not even fully spend, but set in motion about 5 lakh crore worth of infrastructure projects. So the total package, if you think about it then, that I'm talking about, is roughly 5 lakh crores in direct income transfers and about a similar amount in infrastructure programs. Now, if we can do this 10 lakh crores in the current year, what we will be getting is that the growth rate for the current year will be dramatically better. It will not be minus 12.5%. It will be closer to minus 6%. And in the next year, we should be back to a zero growth situation, which means no further deterioration. And by the year after, we would have recovered the GDP level we had in 2019-20. So that's what the scenario looks like. But how you play it out, how you nuance it are important because there are lots of little bibs and bobbles that one has to take care of. And I've tried to address some of those in the paper for any of you who are interested. But the big picture is roughly what I've talked